Hey folks, today I want to talk to you about the new tax provisions that came with the OBBBA. And if you're going to file your tax returns this year for 2025, you need to know some of these tax provisions because they were designed to save you a ton of money, a lot of money. But before that, let me give you a brief presentation about me. My name is Luntadila Paulo. I'm a CPA and I run a CPA firm that helps business owners and taxpayers across the US save money legally without breaking the law. And the new tax provision comes with some of these elements, some of these tax provisions that will save you money for sure. And I'm going to go ahead and share my screen to walk you through at least 3 to 4 of these tax provisions. Just bear with me here, and I'm going to show you all of them. So let's begin with the first one. If you know what happened in the past, right, when the Tax Act Jobs Act was introduced, right, that was in place for the year 2018 to 2024, a lot of its provision came with some of the good, but also some of the bad stuff. And one of the bad stuff was exactly this SALT deduction, right? So a lot of high income state like New York, California, and to some extent Colorado and Chicago, right? People are complaining about this because people are paying a lot of state and local taxes, but the tax law only had provided a deduction up to 10,000, up to 10K. But the new tax provision that is in effect from 2025 to 2029, it bumped up that tax provision to 40,000, right? 30,000 more in tax saving, right? So all of your state and local taxes, now you can deduct up to 40,000 if you're single or married filing jointly, and only 20,000 if you're going to be married filing separately, okay? But there is a watch out here, right? There is an element here that you need to watch out. If you earn over 250K and you'll be married filing separately, right, you can begin losing this deduction. So, you don't have to worry about anything if you're making less than 250 grand and you're going to be filing as married filing separately. Now, for those of you guys who are going to be filing either married filing jointly, or single or head of household, okay, head of household, right? The provision gives you up to $500,000, right? Your income can go as high as $500,000. You still get to keep the entire $40,000, right, in tax savings. So that's number one of the biggest tax savings that came along. Okay. Now, number two, right? Well, before I jump to number two, right, the SALT deduction, right? This is really the timeline that we are seeing, right? For 2025, it's going to be 40,000 and 20,000 if you're going to be married filing separately. And for 2026, this year, right, it's going to be an increase of $400 and $200 for married filing separately. And between 2027 to 2029, this deduction is going to be increasing by 1% each year. And then by 2030, this is going to revert back to the original numbers of up to $10,000, right? So there is a sunset here unless the Congress comes again and makes any changes, right? So again, this is really important for you for tax planning, right? For tax planning, financial planning, right? This is very important. Now, let's jump to number two. This is an easy one, right? This is an easy one. Your standard deduction just got slightly better, right? So if you are not going to itemize and claim these, 40,000, right, in your itemized schedule, now your standard deduction got slightly better, right? For single folks, right, for 2024 was 14,600. For 2025, it's going to be 15K 750. For married filing jointly, it was 29,200. And for 2025 tax season, it's going to be $31,500 deduction. Head of household, $21,900. And this year, or for the tax year 2025, $23,625. Now, there is a huge deduction that came along with the new tax law, the OBBBA, right? The $6,000 bonus. And let's talk about it here in a separate slide. Let's talk about it here in this slide, right? What is happening here? The new tax provision, right? In the former tax law, we didn't have this. We didn't have this senior deduction. Now, right? The tax law is giving seniors, right, $6,000 if you're single or head of household, and the requirement is if you're 65 or older, right? And for married filing jointly, if both are 65 and or older, then that's another $12,000, right? So just imagine, right, if you are married filing jointly, you have 31,000 in standard deduction plus 12,000, right? That's $41,000 in deduction. That's a big saving. That's a big tax saving, right? Big tax saving. And there is, as in any tax provision, there are some phase outs, right? There are limits where if your income exceeds this, you begin losing this tax deduction. And for single or head of household, that limit is 75K, right? If your household income is over 75K, you're single or head of household, this amount begins going down, right? If you're married filing jointly, that limit is 175K, right? If your household income is over that, this amount begins going down, and you lose it altogether if you're single and your income is over 150K, and if you're married filing jointly, your income is over 250K. So you lose this deduction entirely, right? So this is really designed to give the middle America, right, the middle income earners some really great deduction, right? And if you're 60, 65 or older. Now, I want to talk quickly about the car loan interest deduction. Again, another one of these provisions that, up to the end of 2024, it didn't exist. We didn't have this. We didn't have this at all. And it's one of these new provisions that is going to help the auto industry really get a little bit more money. So it's designed to give you, if you purchased a car in the US, right, and you borrowed money to buy that vehicle, and you can get a deduction of up to $10,000 in interest, right? In the past, this wasn't even possible unless you were a small business or business owner who purchased a car under the business. You would have benefited from the tax provision. Now, this is for personal use, right? How great is that, right? So you may deduct interest paid on a loan used to purchase a personal vehicle, very important, acquired after December 31st, 2024, right? So January 1st, 2025, if you bought a vehicle for personal use, guess what? Congratulations to you, right? You would potentially qualify, but there's some other criteria, right? And again, there is, this phase out, right? Your income has to be below a certain level for you to qualify, right? And for these tax deduction, right? For these tax deduction, right? If you're married filing jointly, your income gotta be below 200K, and all other filers, it must be below 100K, and you lose it completely if your income is over 250K, if you're married filing jointly, and over 150K for all other filing statuses, meaning single, head of household, or married filing separately. Now, I want to add a few more details here because this provision is really interesting one, right? So what doesn't qualify for interest deductions here, right? So if you lease the car, lease payment of this kind of financing for a lease is not going to qualify. Out. If you're purchasing vehicles you're financing vehicles purchased for a fleet, this is not going to qualify either. If you are getting a cash out, right, a personal loans using a vehicle you already own as a collateral, that interest is also not going to qualify. If you want to buy a car to be used in the business or for commercial only purposes, also it's not going to qualify, right? If you got a loan for a vehicle with a salvage title, it's also not going to qualify. And last but not least, if you bought a car to be used as scraps or for parts, the interest on that, it's also not going to qualify. Now the question is, what qualifies, right? What is actually makes you eligible to qualify for this deduction? Number one, right, the date you purchased the car. You gotta purchase the car in 2025, January 1st forward, you're good. That's fine, right? It must be a qualified passenger vehicle, right? Used mainly on public roads with at least two wheels, right? Can be minivans, pickup truck, motorcycles, right? It can also be a recreational vehicle, right? Trailers and campers qualify. And here's the catch: the vehicle must have a final assembly in the United States. Meaning, if you bought a Ford but was assembled in Brazil, it doesn't qualify. If you buy a Tesla and it was assembled in China, it doesn't qualify. Even though they are American-made vehicles, it's still not going to qualify. It have to be assembled finally in the US, right? And that's very important. And here's an example of how the specific tax deduction plays out, right? So we have a couple, Marcus and Elena. They purchased an SUV in February 2025. They got a 5-year loan at 7% APR on a 45,000 balance. Their combined modify adjusted gross income, or just let's call it income for short, is 160. And we know these 160, right? It's within their right income level, right? They haven't reached the 200K yet, and much less they haven't exceeded the 250 limit, right? So 160, right, that they have in their income, they paid a total of $2,950 in interest, and their tax bracket is 22%. Their marginal tax bracket, meaning they can actually claim the entire $2,950. Why? Because that's below the annual limit. To make sure, right, they qualify, we're going to run the vehicle identification number in the system to make sure that it was finally assembled in the United States. So very important, right? And that needs to be included in their tax returns. Very important. Now, let's talk about something that really got a lot of people excited, right? Really excited. The no tax on overpay. I want to talk about this and call our attention to certain elements. So again, this is one of these other provisions that before 2025, it did not exist. It didn't exist. It just wasn't there. Okay. So it wasn't there. Now we have this provision in the tax code, and it's in effect between 2025 to 2028. If you're single or head of household, you can claim a deduction of $12,500. And if you're married filing jointly, that's the double, right? That's the double, right? Meaning 25,000, right? And what is exactly that you're deducting? It's not the full overtime, but it's the extra pay, right? So according to the FLSA, right, overtime is 1 times 5, right, of your regular rate. Okay, meaning your regular rate is 1 plus the 0.5. This is the portion that is deductible to you. This is what you'll be deducting. So let's see an example here, right? So if your regular rate is $20 per hour, right? $20 per hour, right? Your overtime, it's gonna be $30 per hour, right? $30 per hour. The amount that is deductible is not going to be the entire $30 on top of your regular pay. It's going to be the extra $10 on top of your regular pay. Okay. So if you worked, let's say, 10,000 or $30, you had overwork of like 100 hours per year, that's $3,000, right? $3,000. Your overpay is only $1,000. That is going to be deductible, not the entire $3,000. Okay, I hope this makes sense. Now, let's look into something interesting here. Again, there are some limitations. Not everybody is going to qualify for this, right? As I said, this is really designed to help the low to middle income earners, right? So if your income exceeds 150, if you're married filing separately or head of household, right, you lose this deduction, right? You would lose it. If you're married filing jointly, the government gave us up to 300K. So there's a lot of room here to, really save quite a bit of money. Now, here's how you can qualify. And this is, by the way, available whether you itemize or claim a standard deduction, right? So both group of people are going to get this. And to qualify, it's really simple. It's a pretty straightforward process. You gotta have a social security number on your tax return. If you're married, you gotta file jointly. If you file married filing separately, you lose this deduction. Okay, your employer or the payer must report to the IRS or the Social Security Administration a statement that shows the total amount of qualified overtime compensation paid. Right, so there is some reporting requirements there. Now let's look into a case study here, right? So let's see, Sarah is a full-time nurse who is paid hourly and frequently works overtime to cover night shifts. And her income is 85 grand, and she had inside this 85K, right, 18,000 in overtime payment, right? So she is eligible of 6,000 deduction, right? Because that's right. So as we said, right, this 18,000 is the total overtime payment, but what qualify is 0.5% or time, excuse me, of the overtime, right? So this is essentially 18,000 because it's within 12,500 annual limit, and she's single, right? Presuming she's single here, right? She can claim the entire 6,000, and that at a 22% tax rate, that translates into $1,320 in tax savings. Now let's look into one last tax provision here, and we're gonna close this for today. Okay, so we're gonna look into no tips on no tax on tips. Again, is one of these other tax provisions that came in and it didn't exist prior to 2025. And now you can actually claim up to 25,000, right? 25,000, whether you're self-employed or an employee getting tips, right? Getting tips. And the IRS is the Congress was really smart with this, right? They actually gave us the occupations that qualifies tips, right? And they told us what qualified tips means, and we're gonna talk about them here. So again, the same provision, the same limits apply, right? If you are single or head of household, your 150 is the limit. After that, you begin losing it, this deduction. And for married filing jointly, it's 350K, right? Above that, you begin losing it. Now, what is qualified tips? What is qualified tips? Okay, so qualified tips means if you're getting paid cash like money. What is cash like money, right? You got tips through cash, checks, credit card or debit card payments, gift cards, or an app payment, right? Like Zelle or Cash App, something like that. And it have to come from a customer. That's very important. It's not some, money that is coming from your boss. It gotta come from your customer, and it must be voluntary. It's not compulsive, right? Compulsory, excuse me. It is voluntary by nature. Okay, so if there isn't these three requirements, then it's unlikely that is a tip that qualify, and employers are going to have to keep track of this, right? For 2025, they are waivers of fees and penalties by the IRS, because it's the year that this was implemented for taxpayers. And if you didn't report this correctly, the IRS will forgive you as an employer. But if you didn't, put these information correctly for 2026 forward, you are setting yourself up for troubles there, my friends. Now, what doesn't qualify as qualified tips, right? Anything that is mandatory, that is added automatically, a charge, a service charge, for example, an automatic 10%, right? That the customer doesn't have a choice and have to pay it. That doesn't qualify as a tip. Any illegal activity, right? Prostitution, pornography, drugs, it does not qualify for tips, right? I'm actually not sure if tips on strip club qualifies or not. I'm gonna be really interested to see how the IRS views strip clubs in terms of this new tax provision, right? The tips, and if you are self-employed or an employee in an SSTB under a section 199A, right? So essentially specified service type of business, right? If you are in healthcare, you're a doctor, you're a lawyer, a CPA like me, an accountant, an actuarial services, performing arts, right? And those are some of these professions, excuse me, that, as a content, if you tip me, it doesn't help me at all. Right? It doesn't qualify. Like, I cannot claim that as a deduction. So not really excited about this one. Not really excited about this one. Right? Now, the occupations that qualify. Here's the list of occupations that qualify, and there is actually a massive list that the IRS put there. And what I put here are just the biggest categories. Okay, beverage and services, bartenders, wait staff, bakers, entertainments and events. Right, there is a bunch of people, right, a bunch of occupation, groups of occupation that actually do qualify for tips here. Do so there is a good possibility here for us to help people restructure their payroll, to help their employees save a lot of money on taxes, right? Because this is not a small thing, right? 25K being restructured into tips instead of regular payroll. Oh, man, that's quite saving there in taxes. Now, how do you qualify for this? How do you qualify? Again, you gotta have a Social Security included on your tax return. If you're married, you must file jointly, right? If you file separately, you lose this. And again, employer or payer, right? For 1099 folks, there is a reporting requirement, right? That shows that cash tip was received and the occupation of the tip recipient, right? And that's going to be, let me actually find occupation for tip recipient and IRS. Let me actually bring that list here for us because the IRS actually provided a guidance recently that shows the list of occupation. Okay, here we go. Let me actually put it here, right? So the beverage and food services, right? So you see here bartenders, wait staff, food servers, non-restaurant, dining room, cafeteria attendants, bartenders, helpers, chefs and cooks, food prep worker, fast food, and counter workers, right? And they literally, break down what, the description of each profession and an example, entertainment, right? I have dancers, musicians, and singers, disc jockeys, right? DJs, except radio, right? Entertainers and performers, digital content creators. So for all of you, my folks, creating contents online, making money that way, you can actually, build a tax strategy around these to save you a lot of money, right? Hushers, lobby attendants, ticket takers, locker room, court room attendants, right? And the list goes on and on and on and on and on, right? And this is really good, really good. And guys and girls, right? This is very important for you to plan for your taxes. And I wanted to put this information in front of you so that when you're filing your tax returns this year, you're not making a mistake. And by the way, I would strongly encourage you to not file your tax returns alone this year, right? This is not one of this year because a new tax provision came into effect and there is quite a bit of changes, and you want to maximize your return. You want to be compliant. You want to do the right thing. Spend a little bit more money, and hopefully you're gonna get it back, or at least stay away from the trouble by having a professional look into your stuff and protect you and your family. Taxes is one of the things that most of us stress about, especially around this time of the year, right? Tax season. So with that, what I want to do, right, is to wrap up with, an example for this deduction specifically. So Carlos is a high-end bartender at a popular hotel lounge in Chicago. He earned 72K, and he had 22,000 in voluntary cash and charged tips. Is a 22 tax bracket, right? And because the 2022,000 in tips is below the 25,000 deduction, that saves him $4,840 in taxes. Just think about that, right? Think about that. That's really awesome, right? Really awesome. So we're wrapping this up, and I want to wrap this up with this, right? So if you need help, if you want to get your taxes down, if you want to, meet with somebody to help you build a tax strategy that is going to help you save money on taxes, whether you're self-employed, you want to launch a business, or you have a business for some time right now, or you're just a taxpayer and you're looking for better solution this year. Hey, get out, get in touch with us. Get in touch with us. Here's our phone number: 773-937-1264. Just send us a text message right now, tax 2025, to this phone number. Okay, 773-937-1264. Or if you are the type of person who likes emails, okay, here's our email address: welcome at yetoadvisory.com, right? Single word, YETO advisory.com. Or, go this, the simplest way: just scan the QR code and you will land exactly to our calendar, and you can book a time that works great for you. Okay, so I'm gonna wrap things up here, and I hope this was very helpful to you. If you have any question, if you want to learn a little bit more how each one of these tax strategy might apply to you, feel free to schedule a time with my team, and that's why we're here, to really help folks like you achieve the most optimal tax situation, reduce their taxes legally, and not live with fear of the IRS. Again, was amazing spending this time sharing with you this content, and go ahead and share with other people who might benefit from this. Again, my name is Lunta Di La Paulo. I'm a CPA. I'm the managing director and founder of Yeto Accounting and Tax PLLC. We help business owners across the state, across the nation, right? And if you haven't subscribed or followed our channels or social media pages, go ahead and do, so that you can get more information like this. Have a wonderful day, and I will see you soon. Cheers.